Hi guys, and welcome to another week ahead video. Now in this week's video, our focus will be on the US dollar. We saw lots of downside in this past week due to the market increasing the expectations for further rate cuts by the Fed. And in this upcoming week, our focus will be, of course, on the coronavirus, as well as Fed rate cut expectations and some very important economic data points. So jump with me now to the video, see how we can prepare for these events and hopefully trade them in the upcoming week as well. Okay, then looking at the baseline for the dollar. Now, the dollar has been hit hard this last week by the coronavirus fears as well as the Fed rate cut expectations. Prior to this week, the dollar did enjoy a bit of a bull run from the start of 2020. Firstly, due to a string of positive economic data points, and secondly, due to safe haven bids as the Chinese economy was dragged lower due to the virus. Now, a week back, the dollar saw an additional lift as a safe haven as the markets were buying the dollar versus currencies that were more exposed to the virus, such as China, the euro, the Aussie, the Kiwi, etc. Even the yen saw depreciation as fears of possible recession in Japan saw markets opting for the dollar as a more preferred safe haven. Now, the very first glitch in the dollar's bull run came in the form of market PMIs that was released last Friday. The market PMI numbers kept up surprisingly well recently, usually outperforming the ISM PMIs, but that all changed as the February market PMI numbers showed a massive drop for the services and the comp measure, coming in below that very important 50 level, showing a contraction in the industry. Now, after the dollar had such an impressive run, the significant miss in the market PMI metric saw a healthy correction in the dollar, but that was just the start of the move lower. In this past week, the coronavirus saw a massive increase in confirmed cases in Europe, as well as more confirmed cases in the US, and the possibility that the virus would spread as rapidly in the US as it did in Europe and in China, as well as the possible economic impact of that, saw the markets price in additional rate cuts by the Fed in anticipation that the Fed would need to step in and reduce interest rates to provide necessary relief for the economy. Now, the market expectations of potential cuts were further exacerbated by the bloodbath seen in equities, with the S&P 500 falling almost 12% and wiping out more than $3 trillion US dollars. Now, the drop in the index was the fastest 10% drop in the history of the S&P 500. Now, this led to also massive moves in fixed income markets. Now, bonds is usually seen as a traditional safe haven, and thus people pile into bonds when we see times of great uncertainty and risk of sentiment. Thus, the increase in rate cut expectations and fears of global economic uncertainty sent US bond prices soaring, and thus sent US bond yields falling to record low levels, which put further pressure on the US dollar. Now, usually when the market foresees turmoil for the global economy, the dollar is a desired place of refuge, but the dollar saw weakness despite of this, as the Fed has a lot more room to adjust monetary policy when compared to other central banks like the ECB and the BOJ. Now, just a week ago, the markets were pricing in one rate cut for the Fed in 2020, but after all of this week's events, the markets are now pricing in almost 4 rate cuts by the Fed, with a 50 basis point cut already priced in for March and about 90 basis points of cuts priced in total. Now, to finish off the week, on Friday, we also had Fed Chair Powell coming out with a surprise statement saying that the fundamentals of the US economy remain strong, but the coronavirus does pose an evolving risk to the economic activity. He also mentioned that they are closely monitoring developments and the implications for the economic outlook, and that they'll use their tools and act as appropriate to support the US economy. Now, for some analysts, that tone and language used by the Fed Chair Powell does suggest that a rate cut is definitely on the table for the March meeting. Now, with markets already pricing in a 50 basis point cut as soon as March, the Fed's hands are tied, so to speak, to act unless they want to surprise markets and stay on hold. Now, looking at the baseline for this week's risk events, this week has a couple of very important events that can spark volatility in the dollars, both to the up and to the downside. After Fed Chair Powell's comments on Friday, we need to pay very close attention to any Fed speakers for any possible signals of monetary policy changes. The Fed's blackout period starts on 7 March, so this week is the last time Fed speakers will have to realign market expectations. Now, we also need to pay attention to the stock and fixed income markets. The market believes the Fed won't stand by and allow stock markets to continue plummeting, and according to Scotiabank, a big enough drop in equities opens up the possibility of a potential inter-meeting rate cut over the next couple of weeks. Also, with the US bond yields hitting record low levels, a further plunge or a quick recovery in bond yields can also be a tradable opportunity to watch for the US dollar. Now, we also have very important economic data points coming up, namely ISM manufacturing and non-manufacturing PMIs, as well as the latest NFP. Starting with PMIs, the market will be paying very close attention to the PMI metrics for 2 reasons. Firstly, these survey-based or forward-looking indicators like PMIs are likely going to give us the very first signals of the potential impact on business sentiment from the coronavirus. And secondly, the catalyst that broke the dollar's recent bull run was a significant miss in that market PMI, which saw the services PMI drop to its lowest number since the inception of the market PMIs for the US. Now, in light of this, the markets will be focused on whether the February ISM numbers show a similar drop. Now, even though there are differences between the market PMI and the ISM PMI, both of them do provide a helpful gauge of economic activity in these sectors and will be important to watch. Also, the services sector accounts for the biggest part of the total employment, which means that sudden drop we did see in the market PMIs does not paint a great picture for the labor market going forward. Now, according to Wells Fargo, with the outbreak of the coronavirus now more pronounced, it is very likely that the factory shutdowns in China will cause further disruptions to manufacturing in the US as well. So we definitely need to pay attention to that manufacturing PMI as well. Now, as always, when you evaluate ISM PMI numbers, make sure to also look at the subcomponents like the employment index as well as the new order sub-indexes, especially keeping a close eye on the employment ones as they are important inputs for NFP coming up on Friday. Then we also have non-farm payroll scheduled for Friday. Now, the labor market saw a very good start in 2020 with massive jumps seen in ADP and NFP and a big drop in jobless claims. Now, given the big jumps in January, the markets are expecting a material slowdown in job growth for February. But as always, we need to pay close attention to any deviations, also watching the wages or average hourly earnings as well as the unemployment rate. That will also be important. Now, looking at potential dovish sentiment shifts that we can trade this week, the most dovish sentiment shift in the dollar would arise from an inter-meeting surprise rate cut by the Fed. This is definitely not the base case and would offer the biggest surprise for markets in this coming week. Now, after Fed Chair Powell's surprise comments on Friday, we need to pay attention to any Fed speakers as they have their blackout period starting on the 7th of March. This will be a key week for them to signal any potential changes. Also, apart from watching out for confirmations of rate cuts, keep in mind that the FOMC seldomly just cut once. According to Wells Fargo, the Fed had 6 easing cycles in the last 3 decades, and each time they saw at least 75 basis points of cuts. Thus, watch out for Fed communication that possibly confirms more than one cut or a possible deeper cut of 50 basis points as the market's currently pricing in for March. Apart from that, we also need to pay attention to stock markets, bond yields, as well as the economic data. At this stage, the market's already pricing in just shy of 4 rate cuts by the Fed. So the highest conviction dovish reaction would come from a combination of dovish factors pushing the dollar lower. Following the record low PMI numbers out of China, we can see on this chart, the market and more importantly, the Fed will be paying very close attention to that US ISM PMIs. If we do see a further significant miss well below the market's expectations, that should further increase rate cut expectations and will most likely see more dollar downside. The labor market has been holding up pretty well recently, and if we do see a big drop in unemployment, or the employment numbers, that'll add fuel to the fire and could also increase rate cut expectations. Also, with bond yields at record low levels, a further drop, especially if we see US 10-year bond yields dropping below that 1% level, that would definitely open up more room to the downside for the dollar. Now, as the coronavirus was the main reason for the sell-off in markets this week and the aggressive pricing for more rate cuts, we need to keep track of any potential large-scale outbreaks in the US, especially in densely populated major cities. That should put further pressure on the US dollar as well. Then looking at potential hawkish sentiment shifts, the interesting thing about the dollar is how aggressive the market has been in this past week with pricing and rate cuts by the Fed. Thus, a lot of risk to the downside has already been priced into the dollar, which does pose some upside risk and opportunities. Markets are currently pricing in a 50 basis point rate cut as soon as the March 18 meeting and almost 4 rate cuts in total for 2020. Thus, if the Fed comes out and pours cold water on the market's current expectations, that can see some unwind of the dollar downside and can provide a great opportunity for us to re-engage the dollar to the upside. However, keep in mind, if we do see Fed speakers deliberately talking and walking back the market's current pricing, that should send equities down lower and give markets more reason to buy bonds as a safe haven, as more investors pile into bonds, and that'll see bond yields lower, and that could put more pressure on the US dollar. So just keep that in mind. Also, looking at the markets, they are expecting the PMIs, the ADP, the NFP, as well as wages to slow from their prior highs. Thus, if we do see a significant beat across the board, that could see some short-term relief for the dollar as well, but any significant rallies from that data should be more short-lived as the main focus remains on the coronavirus. Now, pay also very close attention to any positive coronavirus updates such as possible releases of a vaccine that treats the virus or significant success in containing the virus in the US, we should also see some potential upside for the dollar. Another important point to consider is the dollar's safe haven status. Even though the increase in rate cuts sent the dollar lower, the dollar is still a go-to currency when the rest of the world is in turmoil. Thus, if we do see serious escalations outside the US, the dollar should become more and more attractive, as the US economy should hold up much better compared to the other major economies. Then, looking on how to trade the US dollar, in the case of a dovish sentiment shift, we could look to pair the US dollar against the Swiss or the yen as long as the current risk of sentiment stays in place. If the Fed communication signals multiple cuts this week and gives markets hope of other additional easing, that would be seen as a negative for the dollar, but it would be seen as a positive for equities, which should see a recovery of risk tones and would see weakness for the Swiss and the yen. So just do keep that in mind for pairing the US against those two. In the case of a hawkish sentiment shift, we could look to pair the US dollar against the Aussie, the Kiwi, or the CAD, as long as that risk of tones stays in place. Remember that these recommendations are based on the current fundamental bias for these currencies at the time of writing and can change throughout the week. So make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades.